Robschild. No investment advice. Welcome to the show where we view financial markets using Ben Graham's investment philosophy, macro, technicals, and of course, crystal ball gazing. Today is Tuesday, December 3rd, 2024. Today's episode, we're going to start with talking about the job openings data coming in at the actual number. The A is for actual, 7.7 million job openings. The expected was a little lower at 7.5 million, and the last was 7.4 million. Well, Robschild, you've been saying the economy's about to crash and everything's about to, go to heck. And, it's higher than we expected. And that's a big number, right? 7.7 million? Hold on there, buddy. What's normal for job openings? Let's go over to Fred, the St. Louis Fed website, where they have the most updated data. This is the job openings, total non-farm payroll, and this is it, 7.7 for October's reading. As you can see very clearly on this chart, since March of 2022, where we peaked at 12 million job openings, this has been going steadily down and down and down and down. And what typically happens when job openings are dropping? Well, the last time we saw jobs dropping was during the Great Financial Crisis. So, we have that happening, and I don't see it stopping, going down, or changing direction. It just looks like a little bump in the road to me, but that's just me and my crystal ball. Second thing on today's agenda, still light volume across markets. Apparently, sometimes it's a hangover effect where, people take a little extra break after Thanksgiving. I think it has a lot to do with the fact that this week is an unemployment report. And this is one of these things that if we tick higher or even significantly higher in the unemployment rate, remember that's what triggered the SOM rule that comes out on Friday, the market might be just sitting on its hands waiting to see what those numbers will be. If the unemployment rate is flat or even just like a little higher, doesn't worry the market at all, that could send us in the SPX, the S&P 500, maybe to that 6,100 level that we've been discussing. And if it's higher than we expect, Friday could really actually be a long-term top in markets. We'll have to see. Friday is a huge, huge day. And that's the last item on the agenda, Friday. Look out for that employment report. Notably, tomorrow there's also ADP employment numbers, and that can function as kind of a preview as to what employment number we'll look at. But it's really Friday that's the important number. None of the daily reminders have changed. If you want to see me read through the daily reminders, watch Monday's show for this week. That would be 12/2/24, and it has a freezing bear inside the ball. Although I don't walk through the daily reminders, these are all hugely important things to have in the back of your mind on a daily basis if you are an active investor or trader. With none of the daily reminders being updated, none of the crystal ball readings are updated either. The crystal ball says there's a bear market coming imminently, and there's also no changes in the Robschild portfolio, which I also walk through on Mondays. Taking a glance at some of the charts, starting with the S&P 500, we went up very tiny amount today, 0.05%. Again, with the light volume and the huge employment data coming out at the end of the week, the market is actually acting slightly intelligent here in that way. Like, really, these unemployment numbers can really shake things up. If people are getting all the work that they need, then that will signal to the market that everything for now is perfectly fine. But if the unemployment numbers are going higher and higher and higher and higher, then it's like, oh, well, I can't spend as much money in businesses, so then those businesses lose money. They can't hire as many workers. The whole thing kind of snowballs on itself once you get unemployment continuing higher and higher. We've already, it's been 3 months since the SOM rule has triggered. Will this continue? I say it's very likely to continue, but we'll see. Let's see what happens Friday. The VIX caught my eye today. This prices options contracts. When this is low, it means that the market is not expecting ginormous moves anytime soon. The price of volatility is low, so it's expected that the market's not going to be moving very much. So it's surprising to me because I feel like the employment report could really shake things up. I would kind of expect the VIX to be more elevated. It's all the way down to 1330 right now, and if we scroll out, that's a relatively low number overall for the VIX. If we scroll out even further, we were below that for, let's see, summer of 2023 through the summer of 2024. For about a year we were within that range. Before that, we have not been that low, even all through 2021, and then before the COVID crash, we were lower than that. Any which way you look at it, there's not a lot of worry priced in right now. Next chart, TLT, my favorite place to be. Further explanation in my Monday show. Today we had sort of an engulfing candle the past 2 days. Large red candle. This is suggesting that this market wants to be bearish here. So I'm kind of curious if we're going to be rolling over to the downside here or not at this point. One way to gauge if TLT is really headed lower or higher is to take a look at the 10-year Treasury note. Yes, it's only 10 years, while duration of TLT is either 24 or 26 years, but still, they're so correlated that you might as well just use this as your basic chart. And I don't see anything. It doesn't look like a reversal here. Not quite yet. Again, the employment data on Friday is going to be the determining factor where we're kind of headed next from this point for this week. I mentioned on Monday's show my surprise to see the CME FedWatch tool look all sorts of messed up in the December 2025 contract. They were jumping all over the place. Finally, things have settled, so we're looking at terminal rate after 1, 2, 3 more cuts. Looking at a most likely that we're going to have now it's a 70% chance for a cut now on December 18th, so in about 2 weeks, and then a pause in January, and then another cut in March. The way I'm kind of looking now at Fed funds futures is like the further out you go, the harder it is to guess where it's going to be. And so the most reliable ones are like the very next meeting. And then beyond that, it's really anyone's guess, as I said before. And as I'm learning, to trust what the further out Fed funds contracts say is kind of like, it's kind of, it all depends. It's like driving a ship, and like if the next meeting, if it's priced in that we're going this way 1 degree, but then we don't go that way 1 degree, it's like it changes which continent we're headed towards. And so, further out contracts, I think, are a lot less dependable. And again, these markets change on a daily basis. So it's, in the past, I've said it's the most reliable tool that I have, or that anyone has, for guessing what the future Fed funds rates are going to be. But at the end of the day, it's a really like a guessing game. And then again, the further out that you look at this chart, the more unlikely it is for these to be correct probabilities. By the time, for example, we are in, let's say, October of 2025, are we really going to, have the Fed funds target be on that meeting, 375 to 400? I have no idea, and nobody has a crystal. Well, you know what I mean. It's just glass, okay? Last chart of the day, I brought up copper in Monday's show, talking about this Head and Shoulders top, and how over the past many days we've just been coiling up so tight, and we were like very obviously looking to break out. And I was saying, like, this is after a move down. This is what a bear flag literally looks like. And so the most likely scenario would be break down to the downside from a charting perspective. However, it is this formidable trend line of the whole head and shoulders top, and until we break to the downside, we don't count this as a pattern that will necessarily play out. The fact that it's set up so beautifully tells me that there's a more likelihood of it playing out that way. And then this, like I'm saying, this pattern going straight down on a bear flag, but that's why they call it probabilities. When you roll a 10-sided die 100 times, if there's you're not going to avoid one or two numbers all the time. That's how probabilities work. When you have a 20% chance, it's 1 out of every 5 times you do it. It doesn't play out that way. And so copper surprised me today. We broke out to the upside. I don't know what this means. I don't know where we go from here. I favor the view that copper is more likely to head to the downside because of this bearish move. And, we'll have to see what kind of pattern emerges after this with a giant move like this coming in one day. It wouldn't be unusual for us the very next day to go right back down and continue where we were. But just one, interesting thing that caught my eye today. I want to add at the end of the show that I'm trying to make Tuesday through Fridays kind of additions to the Monday show. The Monday show is like the bread and butter of the week. And I think it's the most important one of my videos for every week. Tuesday through Friday acting as sort of supplements and like daily smaller updates. And, some of them can have bigger things going on, but I wanted to especially make the videos shorter and less repetitive, I guess. So watch Monday's show. I also wrote a comment to fix and explain 2 little things that I'll fix in the next Monday's show to have it be everything be where I want it to be. But anyway, that's all for today. That's all from me and my crystal ball. I hope you enjoyed. Thank you for watching, and see you next time. Rob's Child.